and welcome to episode 93 of
Mo Money,
the investing economics show for millennials by a millennial, where our goal is to entertain, educate, and increase the financial literacy for a whole new generation. I am the host of the show, MC Mo. Now let's get to the money. Now, it must be either the seasonal depression that hasn't worn off, or the fact a new study found people are least optimistic in their 20s, or the fact that I still follow Zero Hedge, but it seems like things are more doom and gloom in the financial markets than usual. I have people reaching out to me and asking me if a crash or a downturn is coming. Ray Dalio and all the other billionaires have finally taken off their rose-colored glasses to see things aren't all honky-dory in the world. But with that, the financial markets still continue to push higher and reach new all-time highs every day. If you follow the markets like I do, this would cause a bit of cognitive dissonance. This data looks like doom, but yet the market still bloom. If you're new to investing, this dissonance could make you uneasy and hesitant to begin investing because you're not quite sure what the hell is going on. You think, you know what, I will wait until things have calmed down a bit before I start. But here's the thing. It's impossible to know the best or worst time to invest, but I will tell you this, it's always a good time to start investing. The proof is a piece by Ben Carlson of Ritholtz Wealth Management titled, "What If You Only Invested at Market Peaks?" This piece is about a man named Bob, but I'm going to change his name to Brian to invoke the popular meme, Bad Luck Brian, because this hypothetical guy has the worst luck of any investor in history. In the story, Brian starts by saving and investing $6,000 in an S&P 500 index fund in 1972. Well, from 1973 to 1974, the market crashes 50%. Bad Luck Brian strikes again. But he does not sell, because Bad Luck Brian does not want to be double unlucky. So he just saves in a bank account for 15 years. And then thinking, well, lightning never strikes the same spot twice, he buys $46,000 more of the S&P 500 index fund in 1987. Not again! He says the market tanks 34%, but he still does not sell anything. Fast forward 12 years, he's been diligently saving and saving and saving. 1999, he invests $68,000. Third time has to be the charm, right? Well, shortly after that, Bad Luck Brian strikes again. The market's down upwards of 50 points. Why, God? Why me? He screams, looking at his portfolio on his Bondi Blue iMac G3, but still, he still owns every share that he has bought. Now it's 2007. The market's at new highs. George W. Bush is president. We're in 2 wars in the Middle East. Things are going pretty great. So Brian decides to get in on the action. He's near retirement. Why not be a little risky, right? So 8 years since his last investment, he invests another $64,000 he's been saving. Now, obviously, I don't need to tell you what happened in the financial markets in 2007 to 2008. Even if you're that Saudi Arabian woman who just came out of a coma after 27 years, you can use previous investments of his to deduce what happened to Bad Luck Brian. But, okay, if you're a total moron, the market crashed upwards of 50% again. But again, he never sold a share. In the end, Brian's bad luck runs out because he still gets to retire with $1.2 million. Because not even Bates' raging hatred for poor Brian can compete with the unstoppable force of compound interest. So here's the bottom line. Losses are going to happen in the stock market. It's inevitable. Warren Buffett loses money, your neighbor loses money, you can't prevent it. But what you can do is to keep saving and investing towards retirement on a consistent basis, because the big picture is compound interest will work its magic for you as well. So do not freak out about timing, because in 40 to 50 years when you are retiring, whether you start investing in April 2019 or July 2019, is not going to have a large impact on the end savings. The good news is it's impossible for the S&P to go to zero. For that to happen, the world would have to explode. And if that happens, you don't even need to worry about retirement, because you're going to be dead. There will always be a lot of noise about investing in your life. Buy this, sell now, up, down, sideways. What's most important is to have a solid strategy and never waver. And if you're going to make investment mistakes, as Ben says in his piece, make sure you're biased towards optimism and not pessimism. Thank you so much for watching another episode. You can find new and classic episodes of Mo Money right here on YouTube. For now, don't forget to like, comment, subscribe, share, follow me on Twitter, follow me on Instagram, like me on Facebook, check out my blog in the link below.
Mo Money, signing out.